Hello everyone. Today I talked about encouraging stability in the mortgage market. Government sponsored enterprises Fannie Mae and Freddie Mac back about 60% of all US mortgages, making them effectively monoline insurance companies holding large amount of mortgage credit risk on their balance sheets. They help safeguard the consistent functioning of the mortgage market to ensure that the type of stability they require diverse sources of capital to transfer risk, including the reinsurance markets. In this episode of Foresight Guy Carpenter expert Jeff Krohn and Tim Armstrong share their insight regarding how to credit risk transfer program de-risk the mortgage industry. About Guy Carpenter's Foresight podcast series, our goal for this series is to bring to listener unmatched insight on trending challenges and solutions delivered by specialists from Guy Carpenter and other organizations on the forefront of thought leadership development. Transcript. I am Eric Stanchion with Guy Carpenter. Welcome to this episode of Foresight, a Guy Carpenter podcast series bringing you unmatched insight on trending challenges and our solution delivered by Guy Carpenter, expert on the vanguard of thought leadership within the reinsurance industry today. Guy Carpenter, Jeff Krohn, Managing Director and leader of the Mortgage and Structured Credit segment, and Tim Armstrong, Managing Director, will discuss one of the reinsurance industry's most successful public-private partnership. Um, and to date, the government-sponsored enterprise or GSE credit risk transfer program and how it has transformed the business models or Fannie Mae and Freddie Mac and serves as the model for mortgage, insurance, and financial institutions that manage portfolio credit risk. From a reinsurer perspective, they will highlight the advantages of participating in credit risk transfer program and growing responsibility as opposed to purely focusing on adding more property risk. Over to you. Thank you, Eric. 2023 mark an important milestone. It is the 10th anniversary of the formation of the government-sponsored enterprise CRT or Credit Risk Transfer Program. To date, over 54 billion of credit risk has been transferred to the insurance and insurance company on 3.2 trillion of unpaid principal balance of single-family mortgage loans across 153 transactions. And while transactions have been issued in the capital market, these insurance and reinsurance transactions have guaranteed 4.8 billion in earned premium to date and an expected lifetime premium of 8.8 billion for the reinsurance industry. The program evolved into a steady flow of highly repeatable transactions, and today we were going to discuss some of the takeaways that have led to the success of the program over the last 10 years and how these learnings may be more broadly applied to other portfolios of credit risk. In the context of Fannie Mae and Freddie Mac's credit risk transfer program, Guy Carpenter act in the capacity of an advisor and broker transacting in the insurance and reinsurance markets. As a part of every marketing submission, we provide a detailed analytics package that include deterministic and probabilistic modeled views of transaction being marketed outside of the playlist process. We also help educate prospective reinsurers that are considering the GSE credit risk transfer program as an avenue for growth and diversification. With me today is Tim Armstrong, who is formerly divisional CFO with the Freddie Mac and will bring an insider's perspective to today's discussion. Welcome, Tim. Thanks. It's great to be here to discuss the success of the credit risk transfer program and other application of credit risk transfer. Alright, why don't we start with some of the basics? Sure, the acronyms GSE stand for Government Sponsor Enterprise, which we will use to referred to Fannie Mac and Freddie Mac collectively. Both we were established pursuant to separate act of Congress, which created specific character that governed the scope of the activities. The core business model of the GSEs is to purchase mortgage loans on single-family home from bank and non-bank lenders, which create liquidity and allow those lenders to originate new mortgage today. And the GSEs fund about 60% of all the mortgages in the US market. And the GSE acquired loans are not just any mortgage loan, they are underwritten to very specific standards, right? That's right. In addition, every GSE loans with a loan to a value ratio above 80% must have a credit enhancement. This is typically in the form of private mortgage insurance. The GSEs then packages these thoroughly underwritten mortgages into the mortgage-backed securities and distribute the mortgage-backed security to the broad array of investors around the world. It's important to note that the GSEs retain 100% of the non-payment risk of these mortgages, and it is that credit risk that becomes subject to the credit risk transfer program. The GSA really exists to ensure that the consistent functioning of the mortgage market through time, in good time and bad time. To promote stability like that, they need diverse sources of capital, including the insurance and reinsurance markets. Exactly, and because the housing and mortgage markets play such an outsized role in the U.S. economy, there have been a number of very important reforms and innovations to come out of the great financial crisis that give rise to our conversation here today. Thank you.